letting me do this. Um, so the reason we wanted to keep this session to only 50 people was because we wanted to run a pilot of sorts to see if the content is easy for everyone to understand, if it's good enough for us to scale up for sure. So we would love your feedback towards the end of the session as well. And it's going to be a comparatively shorter one with not too much of an information overboard. So I'm going to leave a lot of space for questioning me, any specifics you have, any doubts. If your questions become my questions, then I'll direct you to the right person. So yeah, you can rest assured that this in no way is going to be misleading you. Um, so my journey with like financial planning started when I was helping my grandmom. Like she was, I think, 68 years old when she withdrew money from an ATM for the first time. And with that came like independent decisions. And although my grandmom used it mostly on like grocery shopping and like managing the house, she was able to do that independently without having to ask my granddad, which I think was empowering in its own little way. So I felt like there was a unique subset of people at led by women that were beginning to work or were looking for jobs and about to work that obviously would have some sort of stable income, but could possibly use a little bit of guidance and know-how on how they can grow their wealth. So today, I just want to demystify some financial investments topics. It's going to be super simple. I'm going to try to use as many examples as possible. And at any point, if you have questions, please feel free to jot them down, and I'm happy to take all of them at the end. So yeah, the reason I called this session of series, this series Amanat is because Amanat in Urdu means like trust, and it basically means that we're sort of trying to build our wealth and reduce our dependencies on everyone that's around us. I think this is the stepping stone to sort of financial planning. So this is why we're here. I'm going to stop with the backstory and actually get started with the session now. But why exactly are we here? I think the key point to notice is that we all like money. Money is great. It's going to be definitely a fun process to build your wealth, especially when you're earning your salaries. But there's also like deeper meaning to why we're here today. Women tend to have a higher life expectancy, so they need a financial cushion. Currently, the gender wage gap is pretty high in India and across the globe. Women do land up taking a beating in terms of their careers because they have to take breaks to manage the family or dependents. And there's obviously major issues related to financial inclusion, women not having bank accounts, and even if they do, most of those accounts aren't used. So yeah, we're here to help break out of that cycle to ensure that the generation after us doesn't need to have to go through this session. Um, so let's get started with the main reason we're here is to show us the money. So it's time for us to think about what exactly we need to consider within our financial planning journeys. The first thing you should look at is the 50-30-20 rule. This is the rule of money, and it basically talks about what proportion of the money you earn needs to go to different things. Now, this obviously isn't a cut and dry rule, and you can redistribute your money to something over another. But overall, 50% of your funds would usually go to non-negotiables, like paying your rents, for your groceries, your electricity and water bills, transport to work. All of those are non-negotiables. You need to spend money on them, and therefore 50% is usually where the number is at. And if you feel like your basic necessities are exceeding more than 50% of your salary, that's when you need to think about like cost cutting measures or even thinking about trying to look for a job that can possibly increase your income. The next thing is wants. These are things that are nice to have that sort of help you get comfort and enjoyment in life. It could be as simple as ordering food out through Swiggy or even like having some sort of entertainment through Netflix or Spotify or any of that. So these are the flexible ones, and reducing them would give you more savings, but obviously reducing them will also significantly reduce your happiness. So don't completely get rid of that. And then the third is 20% of your income would ideally go to what we're going to be focusing on today, your savings and investments. So this is what you do for yourself. These are your future this is you securing your future by spending on extras. So you will be setting money aside for emergencies, you will be investing your money into different sorts of opportunities, and you will be having, let's take a provident fund through your company that will be giving you a pension later on. There's different ways in which savings and investments can take part in your life, and that's what I'm going to be deep diving into today. But this is roughly what your journey into financial inclusion would look like. So what's happening is that most of this breakup is 50-50, or even if they're like, for instance, if there's 50% that goes into needs, the other 50% is divided into wants and just savings, but there's no wealth growing aspect. So it's actually important for us to demystify what that last box, what that 20% actually entails. So what that entails is basically three major pillars. The first pillar of anything in your financial journey is savings. So you get money into your bank account, that money stays. In some cases, people do fixed deposits, so that money is set aside. And what the bank does is that, okay, if you don't want to access that money for an hour, for a year, they will give you some sort of interest. Obviously, the issue with having fixed deposits is that you get interest, and interest is haram in Islam. But overall, what you need to know is that with savings, you're just setting aside your money, sort of as good as keeping money under your bed. The next thing is credit. Credit is when you're borrowing little bits of money through a credit card or large amounts of money through loans. This is basically money that's not yours, but you're borrowing it so as to pay people back in the future. And lastly is investments. This is where you actually grow your funds. You take like 100 rupees in savings, you invest it somewhere and it will grow. So it's basically a way for you to increase your and grow your money rather than just keeping it under the bed the way maybe savings would. Now, why exactly are we talking about credit and investments today? Because savings, while very useful as reserves for emergencies, um, they are probably not going to keep up with changes in the global environment. One of the biggest factors that you need to consider is inflation. Like, your prices will keep increasing, but the money that you have in your bank account is probably not going to increase at the same pace. So savings, in short, won't be enough to keep you stable for the future. So that's when you need to consider aspects like credit and investments that can probably improve your ability to grow your assets and wealth as a larger concept. So before I get into the actual investments, let's talk about credit. Let's just talk about what people mean when they're talking about credit cards. The first thing, as I mentioned, credit is about borrowing money. So you're borrowing money and telling people that you're going to pay them back later on. And a result of borrowing money is paying interest. So you need to pay some sort of interest if you're borrowing long-term loans. But I'm not going to talk about loans today because loans are a different ball game altogether. But today I want to talk about credit cards that will impact your daily life. So many people actually utilize credit cards as compared to maybe their general bank balance in their bank account, which would be through a debit card. The way they do it is basically get a PAN card number, get a bank account, and then usually apply for a credit card. And the bank, based on your profile and your credit scores, will basically give you will give you or give you a credit card. The thing about the credit card is that you'll have like a monthly credit limit that, okay, this is how much money you can spend using your credit card. So it's you basically borrowing money from the bank in little amounts based on the transactions. And at the end of the month you'll pay off those bills. So if you pay the bill off in full on time, then there won't be any extra charges. But if you delay it, then obviously there'll be a lot of charges and very high charges at that would be applied. So overall, what do you need to know? Credit is borrowing little bits of money from people with the promise of paying them back. When you apply for a credit card, you're basically telling people that I am worthy of getting a credit card, borrowing little bits of money, and I'll pay you back at the end of the month. Now, what happens is you basically need to repay the money that comes from the credit card at the end of the month. And if you pay it on time, then there's usually no charges. There might be basic charges based on the type of credit card you have, obviously. But if you don't pay, that's when there's like major charges that would be applicable to your delay in payments. But why exactly would I want a credit card if I don't want the stress of having to like pay the bank back at the end of the month? The reason is because this helps you build a credit score. A credit score basically is a way for people to understand how financially reliable you are. So what having a credit card will do, it'll create a history for you, that this is a person that has used a credit card and repays the money every month. This means that this person is reliable. This person is someone that can handle credit responsibly. So a credit history is very important because these are small pieces of credit. But when you want a larger loan to buy a house or a larger loan to fund your education, having a credit score would let the bank know that you are a reliable person. It's also important that, okay, if I don't have a bank balance right now and I know my salary is coming at the end of the month, using a credit card will be an emergency cushion, being like, okay, I can spend money through this and pay it back once I get some liquidity. A credit card also gives you rewards, like some credit cards give you miles, some credit cards give you points for hotels that can significantly reduce your costs as well. Obviously, this depends on the volume of your utilization of the credit card, but definitely useful. And lastly, it's safe and convenient because what happens is when you're using your general bank account, using your own credit card, your own debit card, if you if someone gets access to your debit card information, they can remove money from your account, and it leads to a lot of potential for fraud. Obviously, in India, the levels of fraud are much lower as compared to the globe because of the current systems that we have in place, such as OTPs that add extra levels of security. But with a credit card, if you're doing a transaction and an illegal transaction takes place, you can report it, and it doesn't mean that your entire money goes. You can just cancel the transaction, and yeah, it's sort of a buffer layer between you and your actual earnings. So there's a lot of benefits to credit cards. The issue is that it has interest if you're not responsible with it, and if you overspend with your credit card, it can create an unhealthy relationship with consumption. So there's a lot of things to be wary of, but it's definitely a good way for you to get started on like building a credit score and like building your future capabilities to get a loan. So this is purely credit, but this talks about your day to day and like how you can spend and consume. So it mostly goes back to within our rules, the 50 and 30%, which talks about the needs and the wants. It doesn't really talk much about investments. So let's actually deep dive into what investments are. Investments would mean that you're putting your money to work so it grows over time. So you're basically saying that I'm going to set aside 20% of my salary to go towards some sort of investment opportunities. So in contrast to savings, where I'm putting my money, let's take under the bed, here I'm putting it into assets that are growing over a period of time. So my money grows from 1x to, let's take 10x over a period of time. Now, there's different investment concepts that I'm going to be talking about today. I have added more than what I've put on the slide. These are the basics of the financial space, and I'm going to spend like 5 minutes on each of these concepts, including all the jargony terms that you should know about, that are mostly talked about as well. Obviously, this isn't going to be the whole extent of these concepts, but I'm going to explain them to you as simply as possible so that you can ask me follow-up questions whenever you need. So we're going to be talking about mutual funds, shares and stocks, ETFs, which are exchange traded funds, and systematic investment plans. So yeah, I'm just going to get started with the most important term that is, I think, universally applicable and is probably the first thing anyone studies in finance, which is what is a share. Now imagine there's a tree, it has a bunch of fruits. What I would do as someone that's purchasing a share is basically purchasing a small slice in that tree, being like, okay, I want to buy 1% of all the fruits that come from that tree. So you're not owning the entire tree, but you're just owning one part of it. And if the tree does very well, you get a lot of fruits from that part of the tree. If it does badly, then you don't get any. But usually there's a consistent level of fruits that you get in all of these cases. So a share is basically like that. You have a company that wants to raise money would basically allow people to buy little parts of its business. So what it means is that I can just go and buy a share in Reliance, which would mean that I would own one very little part of Reliance. So why exactly is this interesting? Because shares are basically You can't just go to a company, obviously, and buy a share. And I think a universally applicable concept that everyone on this call probably knows is stock exchange. We have two stock exchanges in India, the National Stock Exchange in New Delhi and the Bombay Stock Exchange in Bombay, as the name suggests. These are platforms that are overseen by financial authorities within India where all of these shares are traded. So we can create an account with these stock exchanges that will allow us to purchase shares. So these are just the unified trading platforms. So there's a company, we go through a stock exchange to buy a share, and that's how we become investors. Now, a share is basically the smallest denomination of ownership you can have in a company. And yeah, this is basically how most public companies in India raise their money. Now, another term that you'll use a lot, or you'll hear a lot in financial news, is an IPO. An IPO is an initial public offering. If a company wants to raise money publicly and be like, okay, today I want Asba to, or hundreds of people like Asba to invest money into my company, I will basically run an initial public offering where I will register with the stock exchange and be like, from today onwards, I want people to buy my stock. So an IPO is basically the process in which a private company sells its shares on the stock exchange to get ownership publicly for the first time. So an IPO enables a company to allow us, everyone on this call, to buy shares in their company. And as I mentioned already, a stock exchange is basically where securities are bought and sold. Now, there are two ways you can actually buy a share. Either you create an account yourself and you buy the share, or you go through a stockbroker, which I will get to in terms of the process later on. But overall, share just a little part of company that you're buying, and you can do that even through literally your phone. It's the easiest thing to do. But the thing is, you need to be wary of shares because, as I mentioned, you're owning a small part of the company. So if the company does well, your share does well. If your company doesn't do well, not so much. So yeah, that's just one thing to be mindful of when you're doing shares. So then for us, everyday people, like we don't necessarily have the time to keep track of which company is doing well, which company is not doing well to buy shares. So then what does someone like me do when I have a set salary but no time to actually figure out what to invest in? That's when we come up with mutual funds. A mutual fund basically is uh, the financial term for not putting all your eggs into one basket. Now, what I could do as Quanita, the investor, is spend all my money on Reliance shares. But if Reliance doesn't do well, my money is going down. So obviously, I don't want to take that kind of risk. I want to grow my funds. That's all. So what I want to do is I want to invest in a mix of all kinds of companies. I want to invest in Reliance. I want to invest in Apple. I want to invest in many others like Microsoft or whatever. So obviously, like managing every company, seeing who's doing well and not is not going to be possible. So what I want to do is basically invest in a bundle of all of these shares and securities. I basically want someone that's experienced to decide which shares are being invested in, and I just want to buy into the larger portfolio. So basically, what we're doing is we're creating a basket of different fruits. And what you're doing is you're basically buying a part of that basket. So it's not just one fruit, you're buying a part of a fruit basket that has many, many, many other fruits. So it's safer because if one fruit gets spoiled, you still can balance it with the many other nice fruits that you have. So a mutual fund sort of helps you balance between different kinds of shares that you can buy. So how does a mutual fund actually work? It's basically an instrument. Consider it like on the right hand side, you can see a little paper that says mutual fund. Consider it to be that. So I will have let's take a fund manager, someone that's extremely experienced, knows everything about finance, saying that, okay, these are the companies that are doing well. These are the companies that can grow in the future. They created a really good mix of this and said that, okay, this is a mix of companies which will be symbolized by this paper, the mutual fund. Now, the rate of return that you would get by buying this combination of companies would be something, the cost of buying this would be something. Are you interested in buying a unit of this combination? So you are basically buying one little part of that mutual fund. So you'll spend, let's take 20,000 of your rupees into that mutual fund. And what you're doing is buying into a combination that invests in multiple companies. a combination that invests in multiple sorts of instruments, not just companies. So basically, over here, what you're doing is you're handing over that decision-making power to somebody that's extremely experienced, and the only decision you're making is what sort of mutual fund you're going to be investing in. So for you, a mutual fund would be more stable, more diversified in terms of your risk, and it'll be much safer for you in the longer term. So there are different types of mutual funds. There's at least 10 to 20 of them, but you don't need to know all of them. Today, I think you need to focus on just two. The first is equity funds. This is basically the mutual funds that only invest in shares of companies. Shares that I mentioned in the previous one. A fund manager would basically pick a bunch of companies that they want to invest in, and what you are doing is buying into a mutual fund that invests in all of those companies. Another option within mutual funds is tax saving funds. So sometimes when we have income taxes, we basically um, get a holiday from those taxes for a certain amount of money. That money is usually around 1,50,000. But what the government allows is for you to invest your money into a tax saving mutual fund in exchange for paying taxes on, let's take a limit of 1,50,000. Now, why exactly would the government be incentivized to give you the opportunity to invest your money in mutual funds? What the government is trying to do is it's trying to get as much money into the economy as possible. So when you are investing in a tax saver fund, your money would be locked into that mutual fund for a total of around 3 to 4 years. It could be more depending on the time period. That means you can't take that money out. That's going to be an investment. And that money will stay in the economy and will sort of act as a tax holiday for you. So it'll sort of allow you to pay lesser taxes on your gross income. Now, this is very similar to um, uh, like getting, actually, yeah, you got the point. But basically, tax saving funds help you get a tax holiday on a certain amount of money. And it basically allows you to take your money out within like 4 years. But what you need to know here is that this is a good way for you to grow your funds rather than just paying taxes on an unnecessary amount of income. So this is definitely something that I can like deep dive into in a more detailed manner of what the structure looks like. There are different regimes to talk about this, but mutual funds as a whole have a lot of benefits more than just diversifying your risk. They can also reduce the taxes that you pay. And the most widely utilized term within mutual funds is the net asset value. So what they do is they take the entire mutual funds portfolio, all the company assets that have been invested in, and divide it by the total number of units they allow us investors to buy. And that basically talks about the cost of or the value of the one unit of a mutual fund. This net asset value will keep changing. Once every day, they will change the net asset value, which will tell you, okay, how are my funds growing over a period of time? So let me recap what we've done so far. We started off with a share. We said that, okay, there is a company. I want to buy a small part of that company. What I can do is get an account through a stock exchange and then basically invest in one share or owning a little part of a company. That's called a share. But because I might not have the time to handpick which shares I want to invest in, which companies I want to invest in, I want to hand off some of that responsibility to people that know what they're doing. So what you want to do is get a mutual fund, which would basically be a combination of different sorts of instruments together. And all I need to do is buy a little unit of that mutual fund. All I need to do is buy a little part of a fruit basket that has a large number of fruits. This way you can diversify your risk, and you can also like sort of reduce some of the headache that you might have associated with making very important investment decisions. A mutual fund, as I mentioned, can be of different types, not just limited to this screen. But one important aspect you can think about if you're going to start earning soon is tax saving funds, which is basically those that offer tax benefits under certain acts of the government. So this would mean investing money in certain type of mutual funds that will be locked in for a few years. Now, how exactly can I ensure that I'm actually investing money in a disciplined manner? So you will have mutual funds that you've decided that you want to invest in, but I don't have time. I don't have the time to go and like put in money every month. So we made that even simpler. What can happen now is that you can be like, okay, if I earn around 1 lakh per month, I want to invest 20,000 every month into mutual funds, and I want this much money to go to this mutual fund, 50% of the money to go to another mutual fund. So you can create something called a systematic investment plan, which would put in money into mutual funds every month for you, or every on a bi-monthly basis, or whatever cadence that you prefer. So a systematic investment plan sort of ensures that you are disciplined about your investments without having to worry about them. So this is sort of a standing instruction that you are giving the people, the owners of your account, to be like, okay, at the end of the month, I want to give 10,000 rupees to the Nippon index fund in the Bombay Stock Exchange. I want to give 10% of my income to the Edelweiss Tax Saver ELSS fund. There's different ways you can do it. There's different cadences you can use. You can put even smaller amounts of money, like 500 rupees, into an SIP as well. So anything is possible if you set your mind to it. Even if it's a small amount, it could create a big change. And finance doesn't need to have you sitting on your phone and reading about stocks all the time. Sometimes you can invest in mutual funds that are going to give you returns over a long period of time. Now, the thing you should know is that the stock market depends on a variety of aspects. The behavior of a stock market can change based on people's perception of the economy. Sometimes people don't have liquidity because, let's take this pandemic, and the income levels of people have dropped, so they stop investing too much. So the stock market does either badly or very well given economic cycles. But on average, it nets out, especially given like inflation and the economic growth of India. So you need to be patient, and especially when you're investing in something like mutual funds, you need to keep it in there for the long haul, because your money would grow to a large extent only in the longer horizon as compared to more immediately. Of course, on an immediate basis, if the economy is doing really well, you might be able to see immediate responses. For instance, right after the pandemic, in around 2022, India's economy was doing really, really well. I remember investing around 10,000 into like a normal index mutual fund. Within, I think, a month, I saw that my investment had increased by around 20% already. Now, that's a very rare scenario where you'll see that sort of growth in a very short period of time. So it's more about something like a mutual fund, waiting it out and seeing what sort of returns you get. Obviously, this is not going to be the case for shares alone, where a company does suddenly really well and you sell it off at a profit. So sometimes you need to be mindful of how the market is doing. But with a mutual fund and a systematic investments fund, it's about putting your money and just letting it grow over a period of time rather than tracking it all the time. So how exactly can I actually partake in daily trading? So there's one instrument that's very, very interesting called an exchange traded fund. An exchange traded fund is sort of like a cousin of a mutual fund. We call them ETFs. So what they do is um, they price a fruit basket based on what other fruit baskets in the market are doing, or based on how well the other fruit baskets in the market are doing. Basically, if I'm buying an ETF for gold, that ETF is basically tracking the price of gold. If the price of gold goes up, the returns on the ETF goes up. So the ETF is basically tracking other assets, and they're using those assets as basis for pricing. So this is very similar to the sheet of paper that you saw for a mutual fund. That'll be the same for an ETF. Only in the ETF, you can even buy commodities. You can buy gold and silver ETFs. So as you know, in our families, it's very common to purchase gold, because gold is considered an investment. An ETF is a good proxy for buying gold. You can buy a gold ETF and it'll do as well as gold is doing, but without having the headache of having to store the gold, without having the headache of the safety of the gold. You're buying an electronic version of a commodity. So this is sort of a very good example of what we call an a commodity-backed security. So you're basically pricing your ETF based on a commodity that exists. And overall, like an ETF could be a commodity ETF. There's multiple types of ETFs, but another one you can know about is passive ETFs. So what the ETF will do is see how, let's take the Bombay Stock Exchange's Sensex is doing. If the Sensex is doing well, the ETF would do well. If the Nifty in the National Stock Exchange is doing well, then the ETF will do well as well. So what happens is that the ETF is basically tracking the pricing and performance of different sorts of assets. And what you can do is buy into it to sort of grow with patterns in its underlying assets. Before I get into the details of other things, I do want to talk about what the Sensex and Nifty are. So, as I mentioned when we were talking about shares, that you need to go on a stock exchange to buy and sell shares. But how exactly do we know how the economy is doing, how the stock exchange is performing? What the stock exchange does is that it takes a list of its best companies and it sees how their prices are increasing or decreasing. So it's sort of like a weighted average of all of those companies' performances. So in the National Stock Exchange, that'll be called the Nifty, which is the net 50. So they take the 50 best companies in the National Stock Exchange and see how they're performing. And that index is called the Nifty. Similar for the Bombay Stock Exchange would be the Sensex. So whenever you open CNBC, you'll see the Sensex and Nifty figures written. This is them telling you that the Sensex is doing very well. That means the best companies, and as proxy, the whole stock exchange is doing very well today. So that's a good time to sell. And if the Sensex is going down, it's a good time to buy because the prices are low and they'll go up over a period of time. So Sensex and Nifty are good indices for you to understand how the financial world is doing. In the US, you'll hear NASDAQ and S&P 500. S&P 500 is the average of the 500 best companies. So, what have we learned so far? We started off by understanding that there are three major pillars to your financial journey. Savings is setting your money aside, probably in your bank account, or in some cases in a fixed deposit, but obviously that earns an interest, which is not good. The second is having credit, borrowing many levels of credit through a credit card that can help you build your credit score and therefore build your ability to get a loan in the long term. And then investments, putting your money into assets that will grow in the future. So we started off by talking about shares that will be buying little parts of a company. We talked about mutual funds, which is buying little parts of multiple companies through buying a single unit of a mutual fund. We talked about a systematic investment plan, which will ensure that a fixed amount of money is going into different mutual funds over a period of time based on your decision. We talked about an ETF, which is an instrument that tracks other assets to see how prices change and therefore changes in value itself. Now let's talk about one last concept, which is the Provident Fund. For most people that are working, the Provident Fund would be an employee provident fund that is being created through your company. So what happens with this employee provident fund is that the company invests a fixed amount of money into a provident fund, which is basically like a scheme, like a mutual fund that's basically investing money, and you get that money back after a few years. The other half of it is that the percentage that the company invests in your employee provident fund, you can do something similar and invest a percentage of your salary into that provident fund as well. And that provident fund would be kept aside for a period of time and would be given to you whenever you leave the company in lump sum or in installments over a period of time. These provident funds are overlooked by an organization called the Employees Provident Fund Organization. And this is something you should know about if you're taking up formal employment in India, because there's no way that you don't have some form of provident funds as well. A provident fund is also publicly available. Like if you go to a post office, you can invest in a provident fund, which is basically like you can go to the post office, give them 500 rupees to invest in a provident fund for you. The return on this would be slightly lower than you would get by investing in a mutual fund, but these are very safe and run by the government, and yeah, like they're better than saving your money under a bed for sure. And I'm sorry for using that example a lot, but yeah. And lastly, pensions. Many companies also give pension systems. So they set money aside and basically allow you to have a pension over a period of time through the national pension system. Many companies also have a gratuity where if you spend more than 5 years in the company, then they'll start giving you money once you leave. So yeah, different ways in which your finances could be tied to your employment as well, but provident funds are much safer than the other instruments that you had identified before this. So yeah, that was my update on some of the major financial terms that you would see commonly used. I'm only going to speak for the next 7 minutes, and after that, I'm going to let you all speak because I have an hour of your time. So I want to actually set you up on that journey. Like, what does starting investments look like? Now let's go back to our pillars. Let's take a deep breath. Think about savings. Savings would require everyone to obviously earn. So let's think about in a situation in which everyone has a job. You start off with a bank account. So in order to set up a bank account, you will need your Aadhaar card and you will need something called a PAN card, which is a permanent account number. Once you have both of them, you can set up a bank account. Once you set up a bank account, you will obviously get a debit card. A debit card is basically an electric plastic card that you can use to pay money through your bank account. You can also get a UPI account linked to your bank account that will basically help you with transactions, which I think most people know already. The next step is if you want to apply for a credit card, there are applications available across banks, but some banks require you to have a credit score, but others don't. So if you're a first time applicant, there are certain credit card options available to you, which you need to research about. So I think the best way to understand how good a credit card is and the benefits from a credit card are by asking your peers and what they use. That's something that I'm also a work in progress on. So if you have questions about credit cards, I can direct you to someone that knows more. And lastly, about investments. Investments are a tough one. They require you to go a step ahead of getting a bank account. And this is what that looks like. You get a bank account, you use your PAN card and your Aadhaar card for that. After you get your bank account, you need to link it to what we call a demat account. A demat account is a dematerialized account. Sometimes you can get it through your bank, like ICICI has a very good demat account system. I know there are other banks that have it too. I personally use ICICI myself. A demat account can also be opened through apps like Zerodha, through Grow. These are all really good demat account suppliers. So what you're doing is basically linking your bank account to a demat account. Demat account is the account through which you'll make all your purchases. It's very similar to an Amazon. An Amazon is a marketplace through which you buy and sell stuff, but your Amazon account is linked to your bank account where the money comes from. Very similarly, your Demat account is like the Amazon or your access to the stock exchange. On that platform, you can invest in ETFs, you can invest in shares, you can invest in so many things. It's all about experimenting. And after you do that, the good thing about these demat accounts, especially investment platforms like Zerodha, they give you statements that tell you about your entire portfolio, the growth you've had. It shows all the details that you would need to know about your portfolio. Um, the best part is that your demat account is linked to NSDL, which is basically a repository of all transactions that you've undertaken. So once your investment is done, you at the end of the year, you will get something called an NSDL statement. You also get that at the end of the month, but you get a yearly statement which tells you about all the investments you've made, all the profits that you've had, and that NSDL statement is what is usually used for taxation purposes to understand what your gains have been from investments. One thing you should know is that your gains are not taxed until you sell your investments. So if you have mutual funds and you've gained, let's take 1 lakh on your mutual funds as returns, you will have to pay taxes on those returns only after you sell them. Lastly, once you set up your demat account and you decide which mutual funds you want to invest in, by simple, like you can just literally do it on the app of your phone. You can set up an SIP. It took me 2 minutes to do it right before this call because I remembered from this that I need to set up a new SIP. It's that simple. It's like you're playing a video game. The only problem is that it's with your real money, so you can't have as much fun with it. But overall, it's a very simple process if you've learned to demystify and realize that there are safe options out there, and investing your money in the stock market doesn't mean you're going to lose out. Obviously, your investments are subject to market risk, so please be wary of all terms and conditions before investing. You must have heard that a lot, and you will hear that from everyone going forward. But in the long haul, I think investing is going to work very well for you. So make that money, boo. I'm going to stop talking now and let people come in with questions.
Okay, so that was like too much of an information, and my brain is not braining right now. It seems like how how behind I am thinking about all the financial stuff. I feel like my account crying in corner situation. It's like Cool. Sounds good. Sounds good. So, to all our participants, it's your space now. Although we already have our hands up, but yeah, feel free to please raise your hand and we'll go ahead. So, we have Aisha. Aisha, go ahead.
This is
Hi.
Aisha Izhar. Sorry.
Uh, Aisha C16.
Okay, Aisha. Hi. So, hi. First of all, I think thank you, LedBy and Quanita. This was a really wonderful session. I mean, I think as a women, we need a lot of these kind of information, and sometimes we are also very hesitant to ask people, our peers, about these kind of things. I had a lot of questions. Thank you. It was a very wonderful session. First thing I want to ask is like I have some real life cases. First thing is you mentioned about gratuity. So gratuity is, I think, based on our basic salary. So, depending on the basic salary, I think gratuity is built up over a time, like after you have spent 5 years in an organization. So, in my organization, I've already spent 5 years. So, what is the flexibility that we get is select, you can change the salary structure. So, what if first thing, is it based on basic salary? And if I get it changed, like basic salary, if I increase that, so will it have any impact on tax savings? That's my first question. So probably one by one, I'll ask more questions.
You are on mute, Quanita.
I just realized I've been speaking on mute throughout. So yeah, as you mentioned, I think gratuity, first of all, depends on the company. Not all companies give a gratuity. The second is a gratuity is usually a lump sum payment that goes from the employer to the employee, and it's usually, as the name suggests, a reward for long-term service. And in many cases, the gratuity doesn't come when they're in the organization. It comes when the employee leaves the organization, either through resignation, retirement, or even in some cases, death. So it's basically to provide some sort of financial security when the employment ends. And in some cases, like we have in India, the Payment of Gratuity Act, which was set up in 1970s, in the 1970s. So what is the eligibility criteria? You need to spend at least 5 years in the organization, which in your case you have. But it's like in the only exception to this rule is that if the employee passes away before 5 years, they're still eligible for a gratuity. So how exactly is the gratuity calculated? It's basically the last basic salary that you earned plus, let's take an allowance. And what they do is they prorate that allowance based on the total number of years that you've worked. So we call that allowance the durance allowance, which is basically what you're rewarding the employee. So last drawn basic salary plus an allowance that is prorated based on the total number of years you worked. So if you worked for a longer period of time, then your gratuity would be higher. So it's not that it's a fixed amount after 5 years. If you worked for 8 years, then it'll be slightly more as compared to if you worked for just 5 years. Now, what are the tax benefits? I think up to 20 lakhs, the gratuity is tax free. But after that, I think it would be taxable. But it might be best to ask a chartered accountant that as well when you're doing your taxes. But I think there is a limit under the act that is being given.
Okay, thank you so much. I have one more question. Like, as you mentioned about mutual funds, so this is a real life case scenario. So I lost my father in 2009. So
I'm
in
so
two,
sorry.
yeah. So last year I got a call. He invested in mutual fund on my name. I was a minor at that time, so it was only just 2, 3 installments that he paid. And after that, we were also not aware that there was such investments made. So we looked for the papers, and I got some papers regarding that. So where can I check the NAV for the, you mentioned something like NAV for the investment that he
Yeah.
has made. There were just 2, 3 installments, I think.
Yeah.
But so I have called also in the UTI office. So they have asked for certain type of documents and my physical presence, but I just want to check the NAV before I go there. So how
Yeah.
do I check that?
Okay, there are two things you need to think about. But before I get to that, I'm so sorry for your loss. And yeah, it's definitely difficult to to deal with such trying circumstances. And yeah, even if time has passed, it's bound to take a toll on you. So I'm really sorry. And yeah, I'm really glad that you're getting an opportunity to deep dive into mutual funds, however the circumstances. But I really hope they were better. And no matter how many installments your father put, an investment in a mutual fund is going to give you a report on your investments. So if your father had a demat account, which he most definitely did if he invested in a mutual fund, he would be getting an NSDL statement. I'm just going to put that here, NSDL, in the chat so you know the terminology. NSDL statement. This is basically where you'll get information about how much money he invested and how much return is coming from your investment, like how much it's grown over a period of time. So X money was invested, now it's become 2X. That's what you'll get through an NSDL statement. But if you want to look at purely just the value of this of the mutual fund, you can just go online and be like, okay, what is the name of the mutual fund your father invested in? Right now, you will get what the current NAV of that mutual fund is. Will that give you what the value of your portfolio is? No, but it will give you the amount that the current mutual fund is worth, which is what the net asset value is.
Okay, and you mentioned about credit card, so it builds your CIBIL score. So is there any way other than having a credit card to build our CIBIL score, or ITR filing, like I'm filing ITR every year? So is it going to help me with the CIBIL score or it's not? And secondly, if in future, just in case if I need a loan, so will say credit score is like, I think it's mandatory. So if I'm not having a credit card, is there any other way?
That's a good question. Like so far, I think like many loans require you to have a CIBIL score, but I think that depends on the magnitude of the loan and related things. I'm not sure if like there are other ways. For now, I think in our day-to-day consumption patterns, what the CIBIL score considers is your credit history, either through past loans or like credit card payments. It thinks about your credit utilization, like how much you use and how much your limit is, and the length of your credit history. And so far, like none of that directly ties to your income tax returns. Your income tax returns don't have anything to do with your loans. And yeah, to answer your point, I'm not sure if there are other ways outside of credit cards from a day-to-day perspective. It's just taking more loans, but I don't think like taking a loan is the solution to building a credit score. Like you should do that only when it's absolutely required. So yeah, I know that's a very convoluted answer for a simple question, but it's a little more complex than that.
Yeah, and you mentioned something about tax savings funds. So is it applicable for like a new tax regime?
Aisha, I would love to interrupt you because we have a few more hands raised. So
Yeah, okay. So
okay.
probably can we get her mail ID so that we can mail her our questions? So
And don't worry, you can also like stay back. I'm happy to stay as long as you need to answer your questions after everyone's done as well.
sure. Thank you.
Yeah, Romana, go.
Yes, thank you, Quanita. I don't know, I'm pronouncing the name right.
Okay.
My question to you is, like, since 2018 to 19, the trend for credit cards and debit cards has decreased, and online pay, GPay, and phone pay has increased. Then, how do you see tech like AI, blockchain, or fintech changes investment opportunities? As women are seen as less investing than men, generally they earn but they don't invest. So, how to manage this, and what are the opportunities for as women
Yeah.
with this changing trend?
Yeah, definitely. I think the use of UPI has increased quite a bit. And that's not a bad thing. Like money goes straight from one bank account to another. But in terms of the use of a credit card, the benefits that you get from a credit card are very different from undertaking a UPI transaction. Now, as I mentioned, it helps build your credit score, which is very important for future loan investments, but it's also useful to get rewards. The good thing is that UPI now is keeping up with the whole reward system and giving you cashbacks, but I don't know how applicable it is as compared to, let's take the benefits of a credit card. That said, to your point about the change in the investing environment, cryptocurrency and related investment opportunities are extremely volatile. They have very low predictability, as a result of which the risk of your investments are very, very high. So for beginners, or for me personally, I've been investing for around 5 years now, but I don't feel like I can muster up the courage to invest in crypto, even though it's a very, very futuristic field. It's because I can't control the use of my money based on the information I have. There are so many things that can impact a crypto market that will make it fluctuate, and like you can lose thousands of dollars within seconds. So in those sort of environments, like it's good to ensure that you're very well versed with how the market works and you're following the right researchers so that you can liquidate as and when possible. So it's more about being a full-time investor, having your mental bandwidth sort of occupied by a little bit of those investments. What I told you today is more like safe investments that can happen no matter what. And yes, investments are usually or majorly done by men, but there's a new wave of investors that are coming with women earning more money, especially with our generation that's increasing. And there've been a lot of research reports that say that women are supposed to be more mindful and value-driven investors. As a matter of fact, like the investments in climate and environmentally friendly investments has increased drastically as women have entered the investment arena. So things are definitely changing, and I think that starts with sessions like these where we inspire more people to put money into the economy. So yeah, the only way to actually change things is to take the first step yourself and try to motivate your friends around you as well. I don't want to lecture. I think you know all of that already. So yeah,
Yeah. Thank you.
no worries.
Yeah, Aisha, go ahead. And you can tag the
Thank
next
you
person.
so much. Yeah, I'll do that. Thank you, Asbat. Hi, Quanita. Thank you so much for the session. Very helpful. Just one question. How do I differentiate between halal and haram stocks? Halal stocks. What?
Very good question. Very, very good question. I was actually talking to my sister-in-law about this right before getting on call. And she told me that one thing she does, like obviously with shares, it's mostly about researching about the company that you're investing in, if you appreciate their work or not. But with the mutual fund, it's a lot harder because like it's a combination of securities that the mutual fund manager is going through. So it's about doing your due diligence and understanding what combination of companies they're investing in. And there are a lot of ethical mutual funds that exist that don't invest in companies that are, let's take, producing alcohol or tobacco. And yeah, that just requires like a dedicated Google search. I'm not like off the back of my mind, I'm not able to come up with the names of mutual funds that do so, but they do exist and are definitely good options for us.
How do I get to them?
Yeah, I
Like,
think that would
how,
be mostly about like researching what the portfolio within a mutual fund is. So there would be reports that evaluate mutual funds. So it would be interesting to search for the ethical reports behind mutual funds. They might have full disclosure about the companies that are being invested in, and also about the about having standards while they're screening companies themselves.
right.
Yeah.
And are you based out of India?
Currently, yes, I am.
Okay, so if you have any, I mean, I know a lot of CAs, but they are usually non-Muslims, and
Yes.
their way of dealing with money is very different.
Yeah.
So if in case you have, anyone who's from our community, a known recommended person, please share it to us. But probably I can get in touch with him or her.
Yeah, I was actually one of the lucky ones that had like a family chartered accountant. Like, not that we had enough wealth that required us to have a family one, but it was
Yeah.
just they're actually Hindu. They're
Right.
old school chartered accountants, but they just know everything about our family. And my father had told them that okay, yeah, we want to invest
Right.
only in halal opportunities. And my
Sure.
mother started by researching a lot about investment opportunities, and that's how I learned about it. So yeah, I think in terms of knowing availability of chartered accountants, I might not be the person by virtue of
Okay.
having a
No
family
problem.
one. Sorry about that.
Thank you so much, guys. No,
Yeah,
not. No. Thank you so much. Yeah.
nice.
And before moving to Mantasha, let's take a few questions in the chat box. So, Bonita, we have one question from Ramesha. Why do companies share shares with other people? What benefit do they get?
Yeah. So let's take, for example, Reliance. Reliance is worth a lot of money, but that's obviously not money that a single individual can own. So to run their day to day, they need money from other people. And what they do is by selling parts of their company, they're getting money from the public. So that's basically what the main reason people share shares is. It's to raise capital. And what benefit do they get? The money. But what benefit do the investors get? The profits. So that's the key.
We have another question that is regarding what happens when tax saving funds mature. The amount that we receive after 3-4 years, won't that amount be taxed?
Yeah, so with a tax saving fund, it basically gives you a tax holiday on a certain amount of your income, which basically means that you're deferring it for the future. Now, that investment, though, instead of paying it in taxes, you're paying it into a mutual fund, which will then grow. So if you actually look at net, like, okay, if I'm earning money on a mutual fund that I'm investing in, as compared to paying the taxes and paying it later, the benefit is still higher on like investing it in a mutual fund, because those are very stable investment opportunities that will definitely give you profits. Once you sell your, like, you don't need to sell your tax saving funds. Like, it doesn't need to be that you keep it in there for 3 to 4 years and sell immediately. Like mine, I invested 5 years back and they're still in those tax saving funds because they're still growing and I don't see a reason why I need to liquidate them. But at some point when you do liquidate them, there would be taxes applicable on them. I don't know what specifically the tax rate would be, but it would be on the difference that you're earning.
Sounds good. So, Quanita, we have another question that is regarding, can you give some good examples of ETF where we can do investment?
Yeah. Actually, those are the two examples that I gave on the screen. I definitely like commodity-based ETFs, like gold ETFs, because I've always heard that investing in gold is good because the value of gold will always go up. So I want to invest in gold ETFs because the price of the gold ETF will always be valuable as compared to what I invest. In terms of like passive ETFs, I think an ETF based on an index like Sensex or Nifty would be very good, because in the long run, Sensex and Nifty will only increase. That's because of India's economy. Like, we're an emerging economy, it's going to grow. It might go down sometimes, might go up sometimes, but on an average, in a longer period of time, an index backed ETF would be very stable.
Sounds
Don't take my word for it. This investments are subject to market risk. Please read all scheme
And
related.
I'm loving the way that you know that whole line.
Yes, I've had
And
to
the
do this
way,
many
the
times.
way you are reciting, it seems like that the TV is on.
Yes. Who do you think wrote it? Sorry, I did.
Amazing. So, yes, over to you, Mantasha, and then to Varda.
Hi, good afternoon. So my question is regarding mutual funds. Mutual funds is, basically to diversify your portfolio, right? And that significantly lowers the risk factor. But during my research, when I was conducting it some time back, I found out that many major mutual funds are usually ranked high in the risk assessment factor meter. They are labeled at high risk. So why is that when they are basically reducing the risk for you as a single investor, then why are they ranked high?
Yeah, that depends on the type of mutual fund. Mutual funds are not free of risk because it's still a combination of investments in shares. So, but as compared to me going and putting money into individual companies that could either do really well or do really badly, the risk is lower with a mutual fund where someone is making a decision and investing in companies that are stable and give good returns. The thing is, not all mutual funds are the same. There could be index mutual funds that go purely based on Sensex and Nifty, like I mentioned. There could be mutual funds that focus on like tax saver ones that have a mandate of companies. But there could be growth and emerging mutual funds that talk about companies that have some sort of like potential for growth, and therefore like the return that you get on those investments would be much higher as compared to a normal mutual fund. But high return also comes with high risk. So what you can look at if you have lower risk taking appetite is to go for mutual funds that have a set type of companies, like only the companies that are measured in Sensex or only the companies that are measured in Nifty. So the risk and fluctuation within those mutual funds, index funds is what they call it. I'm just going to put that down. The risk for these and the cost for these would be much lower as compared to, let's take growth related mutual funds, which would be a manager actually experimenting with different sorts and combinations of companies. So yeah, it definitely depends on the type of mutual fund you're looking at. And Nope, they're not free of complete risk, but they definitely diversify it so that you don't lose your money completely.
Thank you so much.
Not that you will, but it's just, yeah.
Right. I have just got a quick question, so I won't take much of your time. I see people recommending a lot of books around this area, but I'm just not sure how relevant they are. So if you could, if you could recommend me some really good books if someone want to, deep dive into this topic, I would like that.
Okay. That's a fair one. I've usually learned about stock markets either like in class or in or through videos that research capital markets. What I can suggest is maybe like a book that was used in class. Okay, let me find out which options might be good and actually share them with us, but to circulate later, because yeah, off the top of my head, maybe I'm not able to come up with good ones.
No problem. Thank you.
Thank you.
Fabiha?
Hi, Quanita. Thank you for this session. It was much needed actually. So basically, I just want to give you a quick background information. I have just completed my master's and I'm a fresher looking for opportunities. Fine. So I have been really interested in investing. Fine, but I have no proper knowledge about where to invest, how to invest. So just in this session, I got to know about mutual funds. Yeah, I have overheard about just the word and nothing like the deep information about it. So, about this mutual funds, first of all, what kind of investment would you suggest? What do you think is beneficial? Second thing about mutual funds, how do we start with it? Who do we how do we start with this journey? So, yeah.
I think that goes back to this. You're just starting off, so I think first you just need to not make that money boo that comes after you invest. Sorry. Yeah, this part. So yeah, let's just start off with the job. Or borrow some money from your parents if you have that capacity. But just dip your feet in the water. Start off by linking your bank account to a Demat account. So if let's take you have ICICI Bank, create a Demat account. It doesn't charge any money to create a Demat account. In some cases, you might need to pay like a small fee for the trading, but that's about it. Create a Demat account. Spend 500 rupees, just buy one share. See how it feels to buy a share. Again, just dipping your feet in water. Um, the investment choice depends on reading, depends on what you're actually interested in investing in. The reason we did this session is to tell you that, okay, it's not going to be complex enough for you to make that choice because there are a lot of mutual funds that target what you are looking for. I personally started my investments. I got my first salary. I gave that, like, I split that with my family as gifts. But my second salary, almost all of it went into investing in different types of index funds. Index funds are a type of mutual fund that sort of use the same combination of companies in the Sensex and Nifty. I knew that in the long run, Sensex and Nifty would do well. So I knew that my money wasn't gonna go down. Obviously, there'll be times when like it fluctuates, but overall, or in the long run, it'll do well. So I started by investing in those, and then as I got more confident, I obviously did tax saving ELSS because I started working. I'd spent a year at work, and I didn't want to pay taxes unnecessarily on all my income. And then I also looked at emerging growth mutual funds covering companies that have a lot of potential to grow in the future. So I started with the simple instruments and then I grew over a period of time. And what I said is exactly what I did. The first transaction I actually made on my Demat account was one share of Tata. So if you look at my portfolio, there is one share of Tata and then the rest of my mutual funds. So that's still how it is. So yeah, overall, it's about dipping your feet in water, just getting into the practice of investing, and then after that, you can start experimenting and then getting into ETFs over a longer term if you're feeling less confident about the risks. But these are the steps about how to get started. Start with a bank account, having a PAN card and Aadhaar card, and then creating a Demat account, and then so on and so forth. And trust me, they're so user friendly. Like you'll open an app and it'll be like, oh, this is so cool. This graph looks so nice. And instead of you'd be using the app. I'm speaking for myself, not that anyone uses Instagram that much, but like, continue, please.
We hope, Fabiha, we are able to answer your query. And Quanita, we have this one question in the chat box. Which investment type is preferred for beginners?
Yeah, I think like that's a tough question because I think there's different sorts of investments, and what I said to Fabiha sort of like applies to this question as well. It's about starting by dipping your feet in the water and experimenting with different sorts of investments. Like just start off with something basic like buying a Reliance share or a company that you know is doing well. Um, Maybe buy it when the prices are going down, so you're buying it low and then you can sell it high. I actually dipped my feet into the water also through like a project where I picked different companies that I wanted to invest in and theoretically put in like 100 rupees into each and saw how my portfolio changed over a period of time in a month. So yeah, just doing that, like just trying to make investment decisions about like something as basic as like one share, which is worth, let's take a McDonald's burger, would be a good way to start. It doesn't need to be lakhs of rupees that are going straight away. It's about getting comfortable and then investing your money. Obviously, mutual funds are more long term and stable, but yeah, shares are a good starting point as well.
And Conita, this is my question. If you have to suggest some 5 points or 2 or 3 points, mistakes that usually people do, and you want to suggest to us that that is something please just don't do, what will be those?
Okay. Okay. First of all, not investing altogether. Just I know it's scary. There's a lot of terms out there, but it's just finance is built that way. It's created to gatekeep, where they don't want a lot of people in there, so they use complex terms, but they're really not that tough. Like I'm sure there's a bunch of individuals here that are doing extremely insane things in their lives with their careers. So finance is definitely not going to be the hardest thing they have to handle. So it's just about biting the bullet and like putting in a little bit of money and seeing what happens with it. Ensure that it's money that losing won't harm you, but gaining would only be beneficial for you. So even if it's starting off with 500 rupees, it will be a big change. The second thing I would say is that sometimes we get inspired by our peers to invest, but like when the markets are doing very, very, very well, the prices of companies and the cost of mutual funds are also high. So sometimes it's important to think about when is a good time to invest. So try to like wait it out and actually start observing graphs, seeing how prices change over a period of time before actually going straight in, which is why like starting small also helps. The next thing is just like demystifying what you mean, what your risk-taking ability is. For some people, it's much higher. For some people, it's not. So it's very important to make an informed decision on how much risk you are willing to take. I'm not a risk taker. I just want my money to be safe, and maybe if it improves, great. So for me, given that, I know what sort of investments I want to make. So just be clear on what your ambitions as an investor are before you get started on your journey. And I'm no expert. It's just that I like talking, so that's why I'm here. But any of you can do the session if you invested the way I did.
Helpful. That was really helpful. Yes, Ramesh, over to you. And we'll just take 1 or 2 more questions. And yeah. Yes, Ramisha, go ahead.
Okay, so hi Quanita, thank you so much for the session. Actually, I'm a fresher, so I was not able to understand so many technical terms, but yeah, I got to know 50% of that, and I'm really
Amazing
great.
starting point.
My question is, how do you do market research if you have just started investing? Like,
Yeah.
how do you know where to invest? Which one is the right
Mm-hmm.
company, and which one is going up or coming down?
Mm-hmm. Yeah, market research is so important. And I think it's more important when you're investing in specific shares as compared to mutual funds, but even for mutual funds. What I used to do when I just started was I used to have the Mint or the Economic Times that was available in school. So they have a page on, like, just read the front page. You'll see so much about companies, like this company is growing exponentially, like through an infrastructure project, or another company is buying a subsidiary in Australia. Like, there's going to be such news that helps their share increase in value. So having information about how a company is doing through just general reading is very useful while making those sort of investment decisions. With a mutual fund, it's more process oriented that, okay, how much money do I want to invest, how much do I want it to grow. So that would involve you exploring your Demat account page. Like they'll show you, okay, this is how this mutual fund is doing, this is the cost of its of buying a unit, this is how much its value is. All of those specifics, like looking into the numbers and actually seeing what am I willing to invest in and what am I not, those would be interesting too. So yeah, the research can be twofold. The first is qualitative research through general reading, and then quantitative research through looking at the numbers. And whether or not it's the right decision, usually with like mutual funds, especially for the low risk ones, you can't go too wrong. But for the higher risk ones, I think it's important to give it some thought, get some practice before you're willing to take that step.
Thank you so much.
Yeah, and the fact that you understood 50% of this is more than I would have understood in the first session as well. The point is to give you a lot of information. You can pick up whatever you want from it. And no matter where you go, I think like it's always going to be complex, but it's just about, again, dipping your feet in the water. Now, the next time you do this session, at least you'll understand the 50% that you already did, and then you'll get to 75. So it's about getting from 0 to 1 rather than like anything about that.
Thank
Absolutely.
you.
And Ramesha, you are a fresher. I'm not a fresher, but still all the wires of my brains are like dancing and tingling after hearing the terms. But yes, it's good that we are going ahead and
डरना नहीं है इस बार.
we are at that stage जहाँ पे वो डर खत्म हो चुका है.
हाँ,
तो
अब
अब करना
straight into
पड़ेगा.
it. Send it.
Absolutely, absolutely. So, thank you so much, everyone, for being with us and for being curious and coming up with such curiosity. I am also learning, and let me share my journey as well. I have started doing this finance studies since last 1 month only. Before that, I have no savings. I've been working with for years. I have no saving, no investment. But yes, I realized this year in Jan that yeah, like we are moving ahead. No point of just spending money mindlessly. Allah also doesn't love that. So if we have some resource, we have to take care of that as well. So we all are starting. We are being curious. We learn together. And thank you so much for joining us. And more than that, thank you so much, Quanita, for sharing this information in a way that we can understand. So it's definitely not the first session that LedBy is doing it. It's definitely not the first session that I am attending. But the issue, my personal issue used to be like the way even the mentors used to use the word, the way they used to guide the beginner seems to be like very tough. But today I was able to understand a bit, and at the same time I know that the cohort out here, they've been like, I was like noting everyone's expression, and yeah, we are beginning, and definitely we'll go ahead together. And thank you so much, Quanita, and really looking forward to more sessions. We'll build up on this module. We'll definitely launch it as a separate boot camp, maybe with more sessions, more modules, with some more elements. And we need your feedback. We need your suggestions as well. Help us grow too. What more LedBy can do, how we can improve. And yeah, thank you so much, Quanita, for joining us on now weekend. You have given your most precious time to us. And at the same time, thank you so much to the cohort for being with us. And yes, the recording, the PPT, everything will be shared over the mail. And yeah, we'll look for some of the resources as well. Maybe the book which Quanita was talking about, so we'll share with everyone. So yeah, with this, thank you so much, everyone. Keep learning, keep coming back with more questions, more queries, and make that money boo, definitely.
Thank you. Thank you for learning on that.
Enjoy your
Thank you so much,
weekends. Have a
man.
nice day. Allah
Wish
Hafiz.
you the
Bye-bye.
same. Allah Hafiz.
Allah Hafiz.